Lots to talk about with our next guest. He's Bill Gross, Pimco's founder and co-chief investment officer. Pimco, as you know, manages $1.2 trillion. Bill runs the world's largest bond fund, which has beaten 99% of its peers over the past 5 years. Bill, thanks for waking up early there on the West Coast and joining InBusiness.
Oh, you're welcome, Margaret. Not so early. We get up at 4:30 here, so it's we're well past our wake-up time.
Well, then tell me, because you must have been looking in that early morning hour at what happened in Portugal overnight. Their prime minister says the bond sales success there was success from any angle you look at it. Is that how you view the auction demand?
Well, we don't blame Prime Minister Socrates for touting his market. That's the name of the game these days, not just in Portugal, but in other countries. They're not like Greece, in other words. Yes, I guess we could give it to him in terms of 80% foreign participation, and yes, we could give it to him in terms of a well-bid auction. But basically, these auctions are prearranged sales, Margaret. They're not really auctions. They're bought by domestic banks within Euroland, and then they're rediscounted to the central bank, and so it's internal buying. There are claims of Japan and China and so on, but they're really looking for the private institutions like Pimco and other insurance companies to buy, and we just haven't done that yet.
Yeah, so you sound similarly skeptical about Spain and Italy when they come to market?
Well, they'll come successfully if success is defined by selling bonds. I mean, Portugal did sell a 10-year, but slightly under 7%. That, to me, is not a successful yield. It speaks in the long term to Portugal not being able to service its debt simply because its primary deficit is increasing based upon those high yields. So something has to be done. It is being done, at least in terms of the talking stage, by Merkel and others in terms of extending the blanket of the EU, so to speak, in terms of EU bonds ahead. But Euroland has a high debt problem, and it helps to spread the benefits, so to speak, from Germany outward, I suppose. But I'm not optimistic in terms of the peripheral countries, and we wouldn't invest in them at the moment.
Well, talk to me about what's happening here at home. We do not only have the Fed out there buying debt, but we also have more Treasury auctions happening. What kind of demand do you expect to see here in the U.S., and how far are the bond vigilantes from reaching us?
Well, sure. Yes, the Fed is buying most of the issuance. They don't do it directly, of course. They do it in different maturities and on separate days in some cases. But the Fed will stop buying at the end of June, and that becomes the ultimate question as to what will happen at the end of June. Bond yields and bond prices will be dependent upon inflationary expectations and ultimately on Fed policy, not through quantitative easing, but through the length of time that they keep the policy rate at 25 basis points. We think that extends for the next 2 years at least, and so there's some type of magnet that pulls interest rates down, not just in 5s and 10s, but also in 30s, that keeps them from going to 4.5% to 5% at least temporarily.
At what point, when you look at those yields, when you look past June, as you say, the time to really pay attention, at what point do we get nervous? We were talking with the forecast from Jeff Goodlock, who says 4.25%, that's a real area of worry in terms of economic growth.
Yes, I think so. I mean, ultimately, the size of the deficit, the ultimate amount of debt relative to GDP, which in terms of gross debt in the United States is at 90% of GDP, a level that Reinhardt and Rogoff suggests slows economic growth ultimately by 1% or so. And so the deficit, the debt level, the cost of that debt ultimately bears a significant burden on an economy. In the U.S., if interest rates, for instance, went up by 50% or doubled, to put it in those terms, then the deficit as a percentage of GDP would probably increase by a good 0.5% or 1%, and probably in dollar terms by a good 300 to 400 billion. So ultimately, the future interest costs will be a problematic focal point for bond investors and for policymakers.
We've got Bill Gross back with us for a few more moments now. Bill, can you explain your theory here? I mean, it sounds like when you look at Americans right now, you see a lot of correlations with male praying mantises. Why is decapitation inevitable here?
Well, I used a praying mantis metaphor in my recent investment outlook, pointing out that there are consequences, Margaret, for mindless political thrusting and Washington spending policies. We as Americans eventually lose our heads, just like the male mantis does in the process of reproduction. Hopefully I was delicate enough there. America's answer to a bulging deficit seems always to be mañana. Debt commission recommendations are dead on arrival, and bipartisan compromises result in no tax increases for anyone, and an increase of $500 to $800 billion in our fiscal deficit. And so the point is, current and future generation of American mantises, male or female, will pay for this in terms of a price, and they pay for it in a number of ways. One, I think, in terms of dollar depreciation going forward, and two, in terms of lower real wages and lower real interest rates, which are a cost for investors.
Well, one area where there seems to be a lot of warning happening is on the state and municipal spending areas. I mean, do you think that states should be allowed to go bankrupt like municipalities are allowed to do?
Well, it's very difficult for them to do so, and of course, should they? Certainly if they can or want to, but I don't foresee that as a prospect. I mean, ultimately, the municipal bankruptcies will be at a lower level. I don't subscribe to the theory that there will be lots of them, but there will be increasing amounts of them. In terms of the states, there are some actions being taken. Illinois, hooray, raised income taxes from 3 to 5% in a secret session last night. So that's progress. And Jerry Brown out here in California is doing something, I suppose, to affect some changes and some balances. But states will continue to have some problems as long as Congress doesn't subsidize them, and it doesn't look optimistic from that standpoint. So spreads will be wide, but I don't foresee a significant bankruptcy at the state level.
You don't see a significant problem, but does that mean you disagree with perhaps Jamie Dimon on that front? But does that mean you'd go out and be putting money into munis right now? Would you buy, munis in California and Illinois?
Well, I think Jamie Dimon was talking about the lower than state levels. Correct me if I'm wrong, but and I would agree that yes, that's where the pain will be borne. I mean, that's in California. That's what Jerry Brown is suggesting: shift the burden from the states back to the local communities and have them consolidate their operations, their services, police and fire, etc. And that makes reasonable sense. In the process, there may be some bankruptcies as well. So I would say at the local level that we should be very observant and aware in terms of potential bankruptcies. But at the state level, when you have 300 to 350 basis point spreads on California bonds, ultimately those are attractive relative to the U.S. Treasury, by the way, which is in a similar predicament.
All right, but we got to leave it there. But I was gonna say I wanted to talk to you about your thoughts on tech and all this. You're quite tech savvy. I hear you're at 10,000 followers on Twitter now. Quite impressive.
Oh, thank you. We're Twitter savvy. Thank you very much.